So yeah, without further ado, I'll stop sharing my screen and Anthony, take it away.
All right. Hey everyone, great to see you. I think there's some new people, and I think there's some people who hang out on all of our webinars. I'm amazed. So I think last time we were going to talk about 10 things, the 10 most important things for a funding round. We covered some of them, and I think what I'll do is I'll whiz through the first set now, and then focus on the second part and deep dive. And if you want the first part, we've got the video from the last session available. So the first thing is, what is a funding round and why do you want one? So my take is, if you sell cheese, go to the bank and borrow money, use the money to buy more cheese, sell the cheese, pay the money back to the bank. The problem is the bank only makes 8% interest a year, so it only works for them if they have a 90x% chance of getting their money back. But if you don't have revenue and your business is risky, the bank won't lend you money. So in exchange, you're going to give them equity with the promise of a much higher return. They're going to get 5 times or 20 times their money back if all goes well. Of course, there's a much greater risk, and they'll make their money back when they sell their shares later. And unlike borrowing money, you don't need to repay it. So borrowing money is only an option if you've got revenue, and if not, you're going to sell shares in your business, and people are going to take a greater risk for a greater reward. So your problem space now is divided into 2 parts. One of them is persuading people to invest in you, which is why you're going to have a great pitch deck, you're going to have a great business plan, you're going to find investors, you're going to use the likes of Robot Mascot to help you create a pitch deck. But the second part is to come up with the right checks and balances and all the legals to make sure that if things go wrong or things go right, you and the investors are both protected. And that's what SeedLegals, our job is to help do. So putting aside the finding of investors for now, and jumping straight into the things to do. So thing number 1, get your cap table right. So at some point you've had an idea, you're now going to incorporate your company on UK Companies House. Great news, you can do that in a few minutes, costs 12 or maybe now 13 pounds. And the important thing is, do not believe crazy accountants who tell you to create 6 different share classes. They're called alphabet shares, A's and B's and C's. All that happens is when you have investors in your next round, they tell you to undo them because they're very complicated. So the standard formula is, 100 ordinary shares split between the founders. Later on, you'll do a share split. So you can do that, both the incorporation and the share split, very easily. And now you are going to look standard for investors later, and they won't see friction and bail. Next thing, when it comes to allocating shares to team members, there's a very simple rule, which is if your shares have no value, you can give people shares for free. I mean, investors pay for their shares, that's separate. But once the shares have a value, then you should give share options instead of shares, because giving shares that have a value to an employee will lead them and the company to have a tax liability. So in the early days, giving 5% to your CTO, knock yourself out, allocate new shares. But once you've done your first funding round or about to get to your first funding round, stop giving shares, at least to team members. You might give them to suppliers or something like that, but instead create a share option pool and create an EMI options scheme and give share options to those team members instead, which is a tax advantageous way of giving them equity. The next thing is, when you give shares to people, it's one of 2 ways. Either investors give you money and you give them shares, or people, employees, consultants, do work for you and you give them shares or options in return for the work done. So whenever you have an employee or consultant, or even a provider who's giving you services and you're giving them shares or options, never just give them all the shares on day one. Make sure there's a vesting arrangement. So if they fail to deliver or they leave the business, they have to give some of them back again. And I see that too often, particularly with suppliers, where these days businesses are looking to save money and give equity instead of giving out, cash. And so instead of saying to a supplier, I'll give you £20,000 for building my mobile app, you might go, how about I give you £10,000 and £10,000 worth of share options in the business. And if you can persuade a supplier to do that, that's brilliant because it saves you money and the supplier is now vested in your business. So it's a nice win-win. But in the same way, you shouldn't give them 10 or 20,000 pounds on signing of the agreement and hope that they deliver your mobile app. You're going to wait for them to deliver according to milestones and pay them for milestones. Likewise, you should create a consulting agreement that has their options either granted or vesting step by step as they perform each milestone. So if it doesn't work out, either with a supplier or maybe it's a board member that you want to give them as a non-exec director, you want to give them some options. If they're not pitching up at board meetings or not giving value, you can terminate. They keep the options that are vested and they return the rest. And you can do all of those with consulting agreements on SeedLegals. So the next one is about valuing the company and figuring out how much to raise. So I know I've covered this last time, but I think people can always hear this again. So I think we'll start somewhat facetiously, but I think funding rounds, whenever I see a pitch deck, and I saw one today, I'm always thinking, what stage is the company at, and does that match their valuation? And of course, I've been around and seen many slide decks in many companies. Some investors are new and naive. Some of them are seasoned professionals. Anytime you have a seasoned professional, they're going to be benchmarking your company with others they've seen. So here, broadly, I think are the patterns that I'm seeing. Step one, nobody invests just on a PowerPoint. So we see founders putting a median of £26,000 of their own money into the business before they look for outside investment. And then you've got a prototype or a mock-up or maybe even something built. You've got a website. It feels tangible. It's not just you waving your arms going, yeah, I'm building this amazing. You've got something to show. The next step is maybe raising £50,000 from friends and family. So these are people broadly who are going to take a punt. Nothing's been really built substantially yet. And we're going to work out in a moment what your valuation might be. Actually, you might raise £50,000 on maybe a £300,000 or £400,000 or £500,000 valuation. The next step is to raise £150,000 or £200,000, often at about £800,000 to £1 million valuation from angel investors. And if you can find 10 angel investors at 15 or 10 or £1,000 each, there's your funding round met. And those angel investors are going to be looking for ordinary shares. So it's nice and simple. They'll get their SEIS. And at that point, you are diluting by about 15%. So you're giving away about 15% equity in each round. Your next round, and maybe now you've got traction, your app is live, you've got some users, you don't have substantial revenue, you might be doing a few £1,000s a month in revenue, you've got a few thousand users. So you've validated the concept. And investors can see there is something live. They can sign up. They can play with it themselves. And your team, by the way, of course, when you started was maybe like 2 people, the 2 founders. And then when you had your friends and family round, 50K isn't enough to hire somebody full time, but maybe you've got enough money to pay for some web development outsourced or pay for some app development or get someone to work somewhat for equity. Your £150,000 probably lets the founders start paying themselves something, maybe 30K a year or something, and hire 1 or 2 people, maybe start paying your developers. Your next round is 300 to 500 to 700,000 in a seed round. And that's now going to kickstart things. So if you think that your average salary is 50K, maybe 60 with expenses and so on. So 150K gets you maybe 3 people for a bit less than a year. 800, or let's say 500K gets you maybe 6 people for a year. So now you're talking, you can have someone on growth or marketing, you can have 2 developers, you can have someone maybe data at that stage. But I would really be focusing these days, particularly with COVID, on getting some traction. If you're spending all of this money building stuff, and you're going to run out of money before, or have to raise before you get traction, life will be much harder. So if you can show ideally revenue, then that means focusing on getting something simple to market quickly, and then getting to revenue. And if I compare SeedLegals with my previous startups were sort of social networks. You had to get to massive scale before you could monetize it. And life gets very stressful. You have to keep fundraising or sell the business before you're able, or get to traction very quickly, because you don't have revenue until you get there later. Whereas if you focus on a business that creates revenue quickly, then you can start scaling your business. So with my business partner and myself at SeedLegals, we put not insubstantial amounts of our own money into the business first. We had our agreement between ourselves that we would stick to a particular burn rate, and that might be 30 or 40K per month. And that means that no matter what our revenues were, we would scale our business and the burn rate to match the revenue, and we wouldn't scale faster than revenue. So, I've always debated with my business partner. I'm very much more, let's scale, let's launch in these countries, we'll go crazy, we'll get to 100 people. And he's, no. Yeah, this is how businesses go out of business. We should grow more organically. And we were all debating which was right and wrong. But when COVID hit, and there was this moment of, will funding rounds just stop? Will there be no more revenue? Will we have to furlough people? I had to say, he was right, because we had a reasonable bank balance, with cash flow break even. So I could look my team in the eyes and go, team, everyone's job is safe. We've got several years of cash in the bank, even in the worst case. But had we gone crazy and scaled faster, that would have been more difficult. So maybe there's a little side message here, which is, particularly at this time, your investors are going to be looking more than ever before to see that your business, firstly, is, sort of COVID adapted, so that you are taking advantage opportunistically as much as you can. And 2, that you are not at risk of not being able to do a next funding round, and you're super focused on getting to profitability or cash flow break even, or a prolonged runway, and that increases their confidence in investing in you. So that's all about your seed round, raising roughly £500,000, and maybe at about a £2 million valuation, something like that. And afterwards, you're in sort of Series A and beyond territory. And there, your valuation is typically, with a VC investor, seen as 10 times your annual revenue. Now, if you are super fast growth, it might be more than 10. If your growth is pretty flat, it might be less than 10. But it might mean if you're making £50,000 a month in revenue, that is £600,000 a year, maybe that's 6 million valuation. So that rule of thumb, UK investors will often, VCs will often push down on that, and your goal is to push up on that. And of course, if you can get to that sort of £50,000 a month, that's the time to be starting to talking to VCs. Of course, they'll always tell you, that's awesome, come back when you're 100,000 a month. And when you get to 100, they'll go, amazing, come back when you're 200,000 a month. But at some point, you need to call it a day and go, listen, I need to raise to get to the next step. I've shown my product market fit. Are you in or not? So again, to recap, your goal is several stages of funding rounds, each time raising 3 to 5 times what you raised last time, at 3 to 5 times the valuation. All right, so in the very early stages, it's all about angel investors. 80% of all early stage rounds in the UK have individuals for the most part, and they're all looking for, if your business qualifies, their SEIS or EIS tax deductions. So do your SEIS advance assurance, because that's often the difference between love what you're doing, come back when you've got it, versus great, I'm in. So next thing, let's jump now, for those who've been waiting patiently and have heard this before, to the mechanics of a funding round. So, at base, if an investor gives you money, you could just give them shares. You can go on Companies House and file an SHO1, which says, you now own 1,000 shares, and I've got your money. Why does SeedLegals need to exist? Why do people go to lawyers at all? And the answer is because when investors give you money, they want a range of protections, and they want some say in that the company won't pivot and be something they didn't want it to be. They don't want you to dilute them to nothing. They might want to have some say in the future decisions the company makes. You, on the other hand, want to force the investor to, for example, sell their shares. If you have a sale of the company, you don't want them holding you hostage and saying, I need millions to buy my 8 shares. You want to make sure they can't oust you from the company. You want to make sure they keep company information confidential. So a funding round is really a set of checks and balances developed like a chess game over decades. And at SeedLegals, what we've been trying to do is sort of recognize what the moves are and then productize the whole piece, because it turns out that the moves are remarkably self-similar. So let's jump into maybe the most important things in a funding round and explore very quickly the pros and cons of each. So a funding round, you've got a term sheet, you have a shareholders agreement, and you've got an articles. And even for those who probably know this, I'll focus on things you probably or may not know. So interestingly, the company's articles, they don't get signed by anyone, but they're made public on Companies House. That's the kind of interesting pact in the UK, which is this document governs our company, and anyone in the world can go to Companies House for free and see anyone's company's articles. And they can see in a moment the share classes and how it's governed, and they can make decisions on should they invest in the company or not. But because the articles are public, you generally don't want to put any private information in those. You don't want to list the names of the shareholders. You don't want to list any particular things the founders have signed up to. You don't want the employees' options. These things are private to you. So there's a separate shareholders agreement, which is signed by the shareholders and the investors, that is not made public. Interestingly as well, the rules for changing these are different. So the company's articles can generally be changed by 75% of all the shareholders who vote to change it. Now, in the first round, and sometimes in the second, the founders own more than 75% of the shares. So they could change the company's articles to do whatever they want. So the investors go, wait, that's not going to work for us. You could change your company's articles to allow you to issue 1 million shares to yourself, and then I've got like 1,000 shares for my £1 million, and you've got all the shares, I'm diluted to nothing. So to prevent you doing that, I want another agreement, a shareholders agreement, that says you can't do these things without my permission. So in company governance, and sorry if I'm going to bore everyone, but it's really fascinating because the entire way that your company's run is going to be getting the governance right. If you get it wrong, investors will not want to invest on the one side and will force you to do a range of other things. On the other side, if you don't understand it and you give investors too many rights, you find yourself stuck on being able to buy a coffee machine without investor consent. So let's look at it. So we start at the top Imagine it's a pyramid. At the top, there's the CEO. The CEO can do a range of things. So as CEO at SeedLegals, I can happily buy a new coffee machine. I don't need to ask anyone. I can also hire a new web developer and pay them £30,000 or whatever it might be. But I can't hire someone for more than £75,000 without going to the board and getting board approval. So why is this? So normally in a funding round, let's say the investors have invested £200,000 in your company. They would not want you to hire someone for £300,000 on a whim because you're going to be out of money in like 9 months or something. It's not going to work. So they set certain approvals by which you need to go to the board. Now, the board in the early stages of a company is just the founders. So fantastic. What you've got is you've now got some documentation to show that you've done the right thing. So by going to the board, anyone who challenges you afterwards going, why did you do this? Why did you issue these shares? You can now show, I've had a board meeting, we documented it, and you can't challenge it or sue me or whatever for doing it because it was done correctly. So knowing which things you need board permissions for is really important. Running a board meeting is actually very easy if it's just particularly the founders like, hey, Bob, should we meet up? Yeah, let's do it. These days, a Zoom call, document it, sign it, one person signs it, and you're done. We've now automated this on SeedLegals to make it even easier. You can just do it for free on SeedLegals. So now the investors would say, well, it's very nice. You've agreed these things at a board level, but the board's just you. That's no good at all. So going one step down on our pyramid of consents, the next level is your board includes one or more investors. And there, the investors might, by being a director on your company, they get to see all the things you're discussing at board level. They can vote, but their votes may not be definitive. They're just one of several board members. And if they're two founders and one director from an investor, you're still going to outvote them. So going one level down on the pyramid, investors might go, what I would like to have is investor director consent. So this means I'm not only a director on your board, but you have to have my agreement for certain classes of things. And that's described in the shareholders agreement. So some things are simple board voting matters, but other things also need the consent of the investor director. So hiring someone for more than 50K, board decision, but you don't need their consent. Selling the company, yes, you need their consent. So now we go one level further down the pyramid, which is investor consent. So investor consent is getting the agreement, normally of 50% by the number of shares they have of the investors. And in case you have a crowd round with thousands or hundreds of investors, investor consent's normally defined as the voting investors only. So if you are issuing shares to lots of people with small investments, give them be ordinary non-voting shares so that you won't forever having to write to hundreds of people or send them company updates, unless you want to, of course. And it can drive you crazy having to manage lots of people with voting rights. The reality is most investor consents are met by 50% by the number of voting shares held. So even if you did have 50 investors, often the top 3 or 4 will be all that you need to carry a vote. But it does mean that you have to write to all the investors to get their consent on certain matters. So you can see that in your company governance, as the CEO or whatever it might be, you just want on a daily basis to not have to talk to anybody. As an investor, they want to see that you haven't gone crazy and pivoted it into, something that they didn't want on their portfolio or sold the business or do something. And everything is this gamified experience around that. And my goal at SeedLegals is to help companies at different stages pick the right things. So in your very first round, 50K, friends and family, The board, you always have to have a board. I mean, you can't not have a board. When you incorporate, you've got a board. People didn't think about it. Those are the directors, but they're just the founders, and you can do anything you want. When you come to your 150K SEIS round, you might, our data shows maybe 30% of the time you'd have an investor on your board. Sometimes it's because you want their help and guidance, and sometimes it's because they insist. Emotional discussion, I insist on the board. You can go to, on the board, you can go to SeedLegals resources, deal data, and show them it's about 30% of the time on a 150K round. If it's a £1 million round, about 80% of the time there's an investor director. So you're probably not going to escape that. Next, when it comes to investor consent, it's a schlep. You have to write to your investors and ask them to agree to certain things. So you really only want to do that on really important things, like maybe issuing more shares because it's going to dilute them, maybe selling the company, definitely not hiring somebody. You want to write to your investors, go, I'm thinking of hiring a new marketing person. Is it okay? That would be like, I don't want to run my company that way. So investor consents are usually around dilution of investors or selling of the company. And that we start seeing appearing in rounds of 200K and above. At a 500K round, it might be 50% of the time, maybe a bit more, there's investor consent. And again, we've got data on that. And the base of the pyramid is shareholder approval. So you'll pretty much always need shareholder approval for anything that relates to issuing more shares and a range of other things. And there again, as the founders, by the way, shareholder approval, they're kind of two bars. One of them is 50%, an ordinary majority, generally for issuing more shares, and a special majority of 75% for doing other things like issuing shares without giving preemption and so on. And as founders, generally, up to the third or more rounds, you own collectively more than 50% of the shares. So shareholder approval is like, hey, Bob, sign here, please. We're done. You have to write to everyone, but you don't need to wait for their approvals. So there's one more thing, which is when you issue more shares under company law, you have to give existing shareholders the right to top up their investment. And the reason for this is that, let's say I've raised money at £1 million valuation. The investors have paid £10 a share, whatever, and they've gotten some small percentage of the company. If I could just issue more shares at any valuation I wanted, I could start as the founder buying more shares myself and diluting the investors. That would be grossly unfair. And I've got the votes to be able to do that. So, when you start looking into this, it becomes a fascinating gamified experience developed over decades. You can see, if you're into product development, I think about the Companies Act almost being product development on these laws, because once upon a time, such a law didn't exist. And then founders just diluted the hell out of investors. And then this law, I'm guessing, was put in place as a result. So this says, if you create more shares, you have to make the same offer that you're making to the buyer of those shares to everyone else to top up their investment at the same price. So if I was the founder to go, I'm going to issue more shares at $0.01 each, my investors have to be able to buy them, be given the chance to buy them as well. So they might go, well, hey, I invested at £1 million valuation. It's now worth £10,000. But okay, fine, I'm going to invest another £73 and I still keep my 5% shareholding. Business is bad, but at least I haven't been screwed. So you have to offer preemption, and that means writing a letter to everyone, usually giving them 10 business days notice to say, we're going to issue more shares. If you want to top up to keep your existing shareholding, write back to us within 10 business days. If we don't hear from you, you're not interested. There's another concept, which is preemption on transfer, which surprises people often. So I'll tell you more about it. So imagine that your co-founder decides he or she wants to leave and sell their shares. So they go and find actually a competitor of yours and go and sell their shares to your competitor at half the valuation you did in your last round. That's a bit of a problem for a few reasons. One, it's essentially, someone selling the shares at half the valuation your investor paid. Secondly, you've now got someone as a shareholder in your company who you didn't want to have as a shareholder, and your investors may be deeply unhappy about the whole thing. So there's this concept of preemption on transfer, which says if you sell your shares, you have to offer them first to the existing shareholders, who can then choose to buy them on the same terms you would have offered elsewhere. So where people are surprised, particularly where an investor or a shareholder is surprised, you give your sister some shares, and one day she goes to sell them and goes, how do I sell them? And you go, not so easy. You have to offer preemption. I can arrange this for you, but you have to offer them to everyone else. And then there's the why. But just so everyone's aware, the idea is when you create a company, the people who bought in earlier always get preference and are able to keep their percent shareholding and maintain that they are the family owning the company before others can hop in. And that's, I think, a nice thing, because it means you always have the option. You can't prevent someone selling their shares, but you do give people internally the right that they can buy them themselves first if you want. So all of which is to just wrap up on this. When you do a funding round, the 5 or 6 or so most important things amongst all the other yada yada is, number one, of course, the valuation, and therefore the amount of the percent equity the investor will get. Number two, what the board will be. Generally, you'll say there are maybe 3 directors in total, of which 2 of them will be the founders and 1 non-exec director. Or on a second round, you might say there are a total of 5 directors maximum, of which 3 of them are appointed by the founders and 2 by the investors. And by the way, boards tend to grow bigger with time, so try to constrain them in early stage rounds to maybe like 3, and then maybe 4 or 5 later on. If you start with 7 initially, it's going to be like, the Cabinet or the House of Lords pretty quickly. It will be ungovernable. So the next thing in the funding round is whether to give investor consent or not. And as I've said, in an early stage round, less than 200K, generally no investor consent. And if there is a larger investor or a fund, they will often want investor consent. The next thing, which I'll get to in a moment, is going to be the warranties and disclosure. But before I get to that, I think one of the fun gamified experiences is, once upon a time, investors would write to you and tell you the deal terms that they wanted. But thanks to SeedLegals, as the founders, you can now create your deal and send it to the investors. Here's my term sheet. And the challenge that you now have is which deal terms should you set? Because you've got the machine in front of you. You can set the controls to be insanely founder friendly or insanely investor friendly or somewhere in between. And here my thought is, some people start with, what is the best deal that I can possibly get for me? That's one approach. You'd set all the deal terms to be the maximally founder-friendly ones. Another strategy is to say, what is the best deal that will likely close at? So I won't pick the things that will be absolutely best that I could get. I'm going to pick the things realistically we're going to close at. And it's a difficult one. And I likened a bit like, maybe I'm going into uncharted bad territory here, a bit like Brexit negotiations, where my reading of it is the EU managed to secure the best possible deal to the point that the deal wasn't made, whereas a better strategy could have been to go, let's get the best deal that would have been made, not the best that we could have in our dreams gotten. And now we'll leave that analogy right there. So what I see often, and say often, sometimes on SeedLegals, is the founders, when we create your round, we suggest what we think are the most likely terms for your average sort of 300 to 500K round. And of course, you can set them one way or the other as needed. But what we sometimes see is founders just like pull them all back to the left. It's all no board consents, no investor consents, no warranties. And sometimes that works. You get the best possible deal. But sometimes it leads investors to just write back and going, dude, that was ridiculous. I don't know what you're on. Here are my deal terms. And they send you their deal docs, which are much more in their favor. So I'm a big fan of quite quickly getting to what you think that those particular investors are likely to close at and offering something close to that as your first offer. And if it's a VC or fund, you might get on a call with them and ask them, hey, you know, what things are you looking for? Which things are important? Some things are important to them, some not. And then you want to make sure that the things that are important to them, they don't have a big disconnect when they see your deal docs and they're just not there. Otherwise, they're just going to have their lawyer redline them and add them all in, rather than going, hey, that looks pretty good. Yeah, I would have wanted this, but you know, it's probably easier just to settle on where we are. So,
Anthony, before we
yep.
before we move on, we've got a couple of questions.
Do you want to shoot over the questions so I can look at the camera? Yeah.
Yeah, the first was from Tony and just wanted to cover clauses around buying back shares from angel investors at an agreed price at market value in the future. So that was the first one. Like, how does that work?
Let's deal with that one. It's
Yeah.
a really interesting question. So you sometimes have angel investors, and I think they're often naive investors, if I may say so, who want the company to buy their shares back later. And I think this is really problematic. It's problematic for several reasons. Firstly, you know, most angel investors are looking for SEIS and EIS, and any arrangement to buy back their shares will disqualify them from SEIS and EIS. So since buying back an investor's shares is not good for the company, and we'll get to that in a sec, you should just leverage that SEIS disqualification to tell the investor, listen, there are two possibilities. You know, we can come up with some method to buy them back later. This is a real problem, but potentially it's possible, but you're going to lose your SEIS. And that's not our rules, as the government's. Or you get your 50% tax write-off. You get no tax on capital gains tax on selling them later. And if the business doesn't work, you write it off. You're much better off taking the tax benefits than a buyback. The second and third problems with the buyback, sometimes it's the investor that wants the buyback. The problem there is, what if the company doesn't have money to buy it back? Can they hit you up? You know, you're out of cash. Maybe that's when the investor wants their money back because you've got problems on your next round. You don't have the money to buy them back. So that's a problem. Or other investors, they want to see their money going into building the business of the company. So if their money is going to pay off a previous investor, that's not building the business. The business is going no further after their investment. And there's another problem, which is you can't use EIS money to repay loans. So this means you cannot even raise EIS investment and use that money to pay off an existing investor. Otherwise, you'll be disqualified from EIS. So you really want to show your investor that if they're asking for this, this is bad. The other point from the company side is the company might want to say, I would like to be able to buy back those shares later. That's kind of cool because it gives you the option to say, well, I've sold 10% equity in the company. Later on, as I start getting diluted, I'd like to get rid of those investors and get them back. Or maybe I'm going to have a fund and they don't want these early investors. So as the company, asking for the right to do it is appealing, but it's got two problems. Problem one, or maybe three. So problem one is by entering into that arrangement, there's little upside for the investor. The whole purpose, from the beginning of the conversation is the investor wants the 5x or 20x upside if your business does well. But if you're offering them to be able to buy their shares at 1x or 2x return, there's no upside. They get all the downside of the high risk, but no reward. So that makes it often not interesting for investors. Again, you can't use EIS money to buy those shares later. So yes, I think those are the problems there. Next question.
Well, so just while we're on that, there's a follow-up from Tony on what you've said in just regards to any precautions that can be put in place, or any clauses that can be put in place against investors if the relationship doesn't work out, and to stop it becoming messy, and that those investors might want to leave, or you might not want them involved anymore. Is there anything you can do there?
That's an excellent question. So for me, I think the starting point is, some people treat investors like friends and advisors, and they have them, on the board, and they give them, a discount because they're going to, be involved in the company, and so on. I like to keep firmly separate advisors. I give advisors money or shares or options, and they give me advice. And when they stop giving advice, we terminate the arrangement in the nicest way. Investors give me money and I give them shares, and my goal is to maximize the return on their investment. But otherwise, I don't expect anything from them, and I don't want anything from them. I mean, your mileage varies. Often people do want the investors to be helpful, and of course, it's fantastic that they are. But to me, I see that as purely transactional. You have shares, my goal, give you return on investment. I would love that you bring your companies to, give me business, and I can hit you up occasionally with, thoughts and, advice. And of course, I'll give you management report updates as agreed, but I don't think it goes beyond that. So the question is, how can you get rid of a shareholder or investor? And, if they didn't have board rights, getting rid of them, there may not be much need to get rid of them because they're on your cap table. It's benign. You have to give them management reports occasionally. If they're not if they're a minor investor or shareholder, there's not much damage they can do. You might still, by the way, by mutual agreement later, decide to buy them out or find someone else to buy their shares or persuade them to sell their shares. But it doesn't have to be your business that buys the shares. It might be somebody else. So, the problem with entering into such a relationship early on, it's now a commitment that rules out SEIs for them, creates problems later, and might remove their upside. So again, in this sort of checks and balances, investors see many, many opportunities. If you've got more friction than someone else, they'll just go somewhere else. So there's nothing inherently wrong with saying, I'd like to enter into an arrangement to buy back your shares later. But if I was the investor, I'd go, you've just taken away my upside. So thank you, but I'll look elsewhere. Next question.
So the final question before we move on to the next bit was don't know whether this is in your remit, to be honest, Anthony, but David asks, what about loans? Do debt investment creditors expect involvement in consent?
Great question. So it seems to be, once upon a time, there were just lenders. They would lend you money and then you'd have to pay them interest, and the debt was secured. So, they'd foreclose on the business if you didn't repay them. That didn't work for startups because they need lots of capital up front before they make any revenue, and it's risky. And then equity investment came along. But more recently, there's some really interesting new developments. I think it was started largely by Silicon Valley Bank, which says we lend you money just like any other bank, but if you call Barclays, they're going to do such a complicated, revenue analysis that you're never going to qualify. Whereas Silicon Valley Bank claim that they think more like a startup, and they'll take a forward-looking view on future revenue and so on. But that was the beginning. But now they're much more sophisticated things, where one of them that I've seen will lend money to companies that are making revenue that is based on Facebook or Google advertising. So in other words, the more you spend on advertising, the more customers you'll get, and your customer acquisition cost is less than the value of the customer. So if you could spend more on advertising, you would get more revenue. So there are now debt lenders who will lend you money only to spend it on advertising to get more customers, and then they will take a percent of the amount of revenue from those customers as a payback. So there's quite a lot of interesting thing in the middle. But I think with debt finance, regardless of how it is, you can only take debt finance if, of course, you can repay the loan. If you don't have revenue, you shouldn't be taking debt finance, or you've signed yourself up to be out of business. But as a debt financer, the answer to the question is yes, for sure. In many cases, if it's a significant amount, they're going to want the same consent rights as investors will want. They might want a board seat. They certainly want management reports. They probably want investor consent rights, even though they're not on the cap table. They have a separate consent right. Plus, they might go further because there may be a priority or a secured debtor. So in the event of a liquidation, they get repaid first. And they may register a charge on Companies House for it to be publicly visible, that in the same way when you issue shares, anyone can see who the shareholders here, anyone can see who the debtor holders are. We have a charge on the company. So on a liquidation, that can then, the administrator can then see everything and so on. Any other questions? Okay, very quickly, a convertible note versus a funding round, I think, was pros and cons versus equity. Okay, so great point, which is, should you do a funding round or should you do a convertible note? The convertible note says, you give me money now, and instead of giving you shares, I will give you shares when I do my next round at a valuation to be determined in the next round. And by the way, if I don't have a funding round in a year or whatever it is, then I will give you shares regardless, and at a valuation we'll agree now. So in a sense, it's a win-win, because for the company, they don't have to agree a valuation now. They don't know what it will be. They can also use the money to grow the business, to increase the valuation, so that when you do the funding rounds and it converts, that investor gets a smaller percent equity. For the investor, a convertible note or an advanced subscription agreement, we call it a seed fast, is a much simpler contract. So you can do it very quickly and easily. For the investor, their upside is going to be that you give them a discount, typically, to what investors would pay in the next round. So a convertible note itself carries interest and a return on capital. So it doesn't qualify for SEIS or EIS. And as a result, convertible notes are not that popular in the UK. UK investors are generally angel investors. And for that, there's a variant called an advanced subscription agreement, ASA. We call it a seed fast. They go like hotcakes on SeedLegals at midnight on a Sunday night as founders hop on and raise anything from 2K to 200K with essentially this convertible instrument to get money in now ahead of a funding round. So generally, here's my suggestion. So let's say that you wanted to raise £300,000. If you've got £300,000 committed from investors, awesome, just do a funding round. If you've got £200,000 committed, you now have a quandary. Do I close a smaller round or do I wait? And the answer there is to do a rolling close round. So on SeedLegals, we call that instant investment. So you close a round for £200,000, whatever you've got right now. but you set it so you can top up later at the same or higher valuation. And that means that you get the money in immediately from the investors who are good to go now, but you don't have to do it all over again. You can just keep topping up according to a set of rules that protect you and the investors. And it can be really easy to do that. But what if you wanted to raise £300,000, but actually you've got £20,000 or £50,000 lined up? What to do then? And that's really what most people need, right? So I really want to raise 300K to last me the next year. I don't need 300K in the bank tomorrow. I need 20K to go pay my web devs or buy some advertising. So I really need 20K. So that's too small really to do a funding round, because those investors are probably not representative of the other investors. The time and effort of doing a round probably makes it not worthwhile. So instead, that's perfect for a seed fast. You give me 20K now, I will give you shares when I do my next round, and I'll give you a 20% discount compared to the other investors because you came in early. Now, if the investor is going to get SEIS or EIS, that seed fast has to convert within 6 months regardless. This is called the long stop date. So it means if you don't do a funding round within 6 months, they're going to have to be issued shares anyway. And they're going to be issued shares at what's called the low valuation. So that's, depending how you play it, either a fail or just as designed. So let's say you think my valuation today, I have no idea, maybe it's £500,000. When I do my next round, I'm aiming to value it at £1 million. So what I'm going to do is I'm going to raise investment with a seed fast now, and I'm going to not define the valuation, but give my investor a 20% discount compared to the valuation in my next round. But if I don't do a funding round in 6 months, it's going to convert. What valuation should it convert at? So now, when thinking about that, I think there are 3 scenarios. One, the reason you didn't do a funding round is business is really bad. No one would invest in you. Second reason is business is really good. You actually are making revenue and you didn't need to do a funding round because you cash flow break even. Reason number 3 is, yes, you're almost there. It's taking longer, COVID, whatever. You want to build some, you just didn't get there in 6 months. It's going to take you 8 months, whatever. But under the HMRC rules, it has to convert within 6 months for the investor to get their SEIS, EIS. And so now you want to think about what would be the valuations, given those 3 scenarios, because it can only be one valuation. So if business is going insanely well, you don't want it to convert at, let's say, 500K. If business was terrible, maybe it didn't really matter what it converts at because there's no business. If you are raising a round at, let's say, business is going quite well at a 2 million valuation, a few months later, giving your investor shares beforehand at $500,000 is a great deal for the investor. So you're going to think through the sort of gamified set of things to find the right low valuation ahead of the round. All right, so I think that we're actually on the hour. What I will cover very quickly is warranties and disclosure. So when an investor invests, they don't want to be surprised later to discover all sorts of stuff as they look beneath the hood, and it's I think I've mixed metaphors, a can of worms. So what they wouldn't want, for example, is you've told them raising 200K for growth, and then it turns out you've got debt of 150K to repay the founder or his friend or the web dev company, and all the money they thought was going to grow the company is instead just going to pay debt, and you need money again. So what you have is the investor says, I would like you to make a set of promises known as warranties that the company has no debt, has paid all the taxes, owns its IP, and a whole range of things. And you can say these are all true or not true. It's a strange gamified experience again. But if you misrepresent that or omit it or lie, and it's not true, the investors can sue the company and or you to get their money back. So it's a fairly limited range of things, but it's really important to get right. As the investor, it protects them from the company misrepresenting things. And as the founders, it's actually your get out of jail card, because, I mean, not literally, but it means that by disclosing something, the investor cannot claim against you later. So if you disclose there's a founder loan, or that you've got a dispute with Bob about the IP on something, the investor, having now read this, can choose to not invest if they don't want to. But if they do invest, then they cannot claim against you for discovering that later, because they deem to have seen that, signed it, and dude, you've agreed on that. So that's warranties and disclosure, which often people overlook because they think it's some yada yada stuff. But it's important for both founders and investors, because it prevents problems that arise if you have, to get back to the question, a disgruntled investor later who says, what do you mean, the business isn't taking off, or you've got costs that I didn't know about? You can then point them to where you disclosed it, and it's a non-issue. So I think that covers it for me. I think we've reached past the magic hour. Maybe we'll have a third session if anyone wants to super deep dive on anything. I've had a lot of fun. I hope it was valuable for you, and we'll have this recording online. So if you have any questions on pitch decks and so on, hit up James. If you've got any questions on funding legal strategy, Anthony@SeedLegals.com, or you'll often just find already on our articles and the resources section on SeedLegals. Thank you very much, everyone.
Fantastic. Thank you very much, Anthony. It's been another incredible session. I think people have learned a lot. There's so much to cover. We could do these sessions every week and not get to the bottom of how these legals work. But there is so much to think about as a founder, and this really helps demystify some of those things. So yeah, we'll have you back very soon, and I'm sure we'll think of more things we can talk about to help demystify even more. But yeah, thank you.